Some may argue that history belongs in the past. We believe it provides a foundation for our future. It informs our wealth of expertise and shows our long-term commitment to ESG. This is not just a trend that we follow.
Good morning, everybody, and welcome to Bloomberg's The Future of Sustainable Investing, Pursuing the Right ESG Strategy. My name is Eric Balchunas, and I'm joining you virtually this morning, unfortunately. Hopefully, we'll get back to physical conferences shortly. So today, we're going to talk about ETFs in the context of the ESG space. It's an area into which last year we saw a ton of money flow. I know because I follow flows every day, and there's last time I checked, I think there was, in the U.S. at least, there was about 70 billion in assets, which is a good 2% of the total assets. So they're truly at the forefront of investors, companies, and consumers' minds right now. We're going to examine in more detail how do you decipher which ETF providers are having a positive impact on the environment and whether they can genuinely address sustainability through this engagement and other issues. This is the big question. Are you making a difference? How does it make a difference in your portfolio? And what are the differences in the way you define ESG? And I think that's what we're going to get at today, and how to think about it and discuss it with your clients if you're an advisor. So before we begin, a couple housekeeping items. First of all, I'd like to just give a nice thanks to our sponsor, Amundi. Also, if you'd like more information on this topic from Amundi, please go to the Resources tab. I'd like to now welcome our community from across Europe, the Middle East, and Africa, and Asia, and also say hello to the thousands of listeners tuning in on social media via the Bloomberg terminal. Welcome. And please make sure you're using Firefox or Chrome for this. Refresh your browser if you're having any issues with sound. You can restore windows using the buttons at the bottom of your screen, and the size of each window is adjustable. Okay, so clearly I'm just reading that off the page, but it's important you know this. So you can also join the conversation using social media. I'm on social all the time. I think it's great. So we would encourage you to focus on LinkedIn, Twitter, and Facebook using the handle @BloombergLive or @Business. So let's get started with our first panel, which I am going to moderate. Joining us this morning, we have Fanny Wirtz, head of ETF indexing and smart beta at Amundi. We also have Fabrizio Zumba, associate director of European Asset and Wealth Management Research at Cerulli Associates. And I'm also delighted to welcome Wolfgang Kuhn, director of financial sector strategies at Share Action. So welcome all of you guys. And I want to just start with a question when you hear about ESG, you'll hear some people say, well, it's big in the institutions and it's going to hit retail soon. Or on the flip side, just wait till the institutions get involved. So I guess let's just sort that out. Is this an institutional or retail story? I'll throw it to Fanny to start that one.
No, that's a fairly good question, Eric. And obviously, we observe that ESG has started with institutions, and notably in Europe, where we do have, I will say, large Nordic, notably institutions that have moved to ESG for years. Right now, there is a vast diversity of ESG investors, obviously embracing institutions, whether they do it for governance reasons, because it's in the definition of their investment policy, because they are forced to. There is a lot of regulation in Europe, in most of the country, which are forcing to push towards sustainable investing at the institution level, but as well also at the distribution and retail investment. Some of them do it for risk purposes, because not looking at the ESG risk, for instance, climate, can be a big drag to the performance of your portfolio. And some of them do it as a performance as well opportunity, like we saw last year with the outperformance of some ESG concern, versus vanilla indices. But it is not only an institutional concern right now. The ESG adoption has moved from institutions to distributors and to retail investors. And notably when it comes to climate investing, where we see a big adoption in Europe and as well in Asia from retail investors to invest into funds, making an action on the climate specificity initiative.
Now, Fanny just mentioned a couple reasons for doing ESG, which is fascinating, and which kind of makes it difficult sometimes as an analyst to really analyze it objectively because it's subjective. What are people's values? Why are they doing it? To outperform, for values, to risk management? Fabrizio, let's talk about the performance. Whether you're going in for any of those reasons, performance is obviously a big deal. And some people, the wrap on ESG is they're overweight tech, underweight energy. And they're vulnerable to what we saw in the past month where energy comes back. Maybe there's a sell-off in tech. Can you just discuss the managing expectations with performance and what investors should expect?
Yeah. First and foremost, thanks for having me. I would dare say that the argument that ESG factors lead to better long-term performance outcomes is a very hot topic at present in the industry. We have something like 2,200 academic studies undertaken in the last 40 years, which have examined the relationship between ESG factors and corporate performance. According to a recent study, a meta-study from Frieda and Bush, 90% of them have found that ESG factors have a positive and or neutral impact on financial returns. If we look at funds itself and ETF, and we look at Morningstar data, a study on a sample of 745 Euro-based sustainable funds show that the majority of strategies have done better than non-ESG over the 1, 5, and 10 years. And sustainable funds actually and ETF outpaced traditional funds during the market sell-off sparked by the coronavirus in the first quarter. To go to your question, the fact that ESG are less exposed to certain sectors, for example, oil and gas, gave them the upper hand in terms of performance compared to non-ESG peers. Even during March last year, when the Brent crude oil price fell to a 17 years old and it was below $26 a barrel. We have seen as well that, for example, in March, while the outflows from traditional funds were high, the outflows in ESG funds were less drastic. I think the main point here and the issue is the low correlation between ESG rating across providers. And this can be explained by the fact that ESG rating agencies screen companies for ESG performance in the same way how credit rating screens company for creditworthiness. The main difference here, as you mentioned at the beginning, creditworthiness is relatively cleared and is defined as the probability of default. The definition of ESG performance is less clear, and it's a concept based, as you mentioned, on value, which are diverse and evolving. Another question here is financial report standards, which have matured and converged over the past century. ESG reporting is still in its infancy. So this point of performance is not an easy issue, if I have to be honest with you.
Go ahead, Fanny. What do you got?
I fully agree with Fabrizio, but I will add 2 points. The first one is that there is no one-size-fits-all when it comes to ESG. Because there is a question, and there is today a vast variety of choice when it comes to ESG. So everyone has to understand what is the fund construction, what does it offers and not, what is the degree, for instance, of ESG is implementing in its construction, or what is the thematic of ESG is willing to address. So there is first an education and an understanding of what is the fund objective. We also observe, when I say there is no one-size-fits-all, is that the concern for a German institutional client cannot be the same of the concern of a retail, Italian, Asian, or even American client. And so there is no one single answer to be given to those ESG demands. We believe that the more ESG adoption is accelerating, the better it is for the industry. Obviously, there is still the concern about the dispersion and the diversity of data, but the more investment will be brought to ESG investing, the more the quality will improve, as we see, notably with the carbon experience with Scope 1 6 years ago and being able to access Scope 2 and Scope 3 right now. So this is a question of education on one side, making sure that everyone is understanding and what he's buying and what it will help him address and not address as an ESG concern. And the last point, which is pretty important, it's not because you invest or not invest into a company that you cannot be active with your money as an asset manager you can be. And notably, and this is one of the topics I know Wolfgang is going to explore, is what are the power of the money as an asset manager we do have to influence annual general meeting of company to make also their strategy change.
Yeah, that's a great point. And this is something that I think sometimes as an investor myself, you could buy an ESG ETF, right? And that's going to exclude some companies, reward some others. And that is a strategy. It's essentially an active strategy. The other option is to buy just a broad index fund, and then you go passive. And by doing that, as we see in the US in particular, the passive companies now own more and more of all the stocks. And so, Wolfgang, let me turn it over to you since you look at this. These index company owners, as owners of these stocks, even stocks that are oil companies, how are they as owners? In other words, are you being ESG just by buying a passive broad-based fund, given that you're handing the keys over to the passive company to vote in an ESG kind of way? How are they doing?
Oh, well, they're doing very similarly to how their active colleagues are doing. Some are okay, others are lacking. We at ShareAction look at performance of voting on ESG issues. I think important to say in this discussion, what does it mean, ESG? And you've said it at the very beginning, different dimensions. To us, there's two definitions that are very, very different. One is about financial materiality. ESG poses risk, so it would be irrational to not incorporate it. ESG impact is materiality to people and planet, and that's very different. That's about responsibility. And we would say that whether you buy an ETF or a passive fund or an active fund, it doesn't really matter. The financial risk is very similar. Actually, if you are in something that can't sell out of particular holdings, then you want to be extra sure, and you might want to tilt your index or use your ETF benchmark to not include something that is risky. If you, whether you are in a passive fund or an active fund, doesn't matter when it comes to responsibility, because in both we would argue, representing civil society, that it is your responsibility to vote your votes and make sure that you have the votes and you use them. I would say to what Fabrizio said on rating agencies, the issue is not just, and Franny said that as well, or talked about data. The issue is not just that we don't know enough yet, or that an ESG rating is an amalgamation of social issues, environmental issues. It's also, if you look at credit ratings, even if they are precisely focused on default probability, in the end, it's an opinion by a rating agency. And oftentimes now they converge, but sometimes they don't, and they can sure be wrong. And the same we need to realize with ESG. ESG scores can be high, but it's just an opinion. You can't have absolute truth of ESG.
Yeah, and Actually, it's very interesting. I agree with Wolfgang, and I would dare to say that active ownership is it's really playing a leading role in generating impact, and this is something that it comes more vehemently after the shareholder right directive 2 in 2019. I would mention here that the point of scale, it's very, very important. And just to give you an example, in 2019, BlackRock they have 45 stewardship team, and attended 6,200 meetings, and they voted 153,000 times. So scale is very, very important here to be heard. But if you look at, for example, there's dedicated firms to active ownership, and these are struggling even to match the scale of the engagement. Just to give you another example, Federated Hermes EOS attended in the same time around in 1 year 10,500 meetings, and cast approximately 110,000 votes. And again, as Fanny was saying, that investors' topics, key topics of interest vary across Europe in this case. For example, French investors focus more on climate. UK institution engagement is more focused on governance. Other markets, such as the Netherlands or the Nordic region, institutions generally take a more balanced approach and invest across many themes in terms of active ownership.
Let's go to Wolfgang first, then Fanny.
Yeah, I just wanted to add maybe that it's also a question of quality of your engagement. It's not just how many thousand votes you cast, and it's important to vote on the important ones, but it's also how you engage between AGMs, what you tell companies they are supposed to do from your perspective as a shareholder of the company. So I think while I agree that scale helps to cover the universe, it is very important that we, it's not just seen as a thing that needs doing, but that is actively considered as a path to long-term sustainability.
Fanny?
Yes, to rebound exactly on what Wolfgang was saying, obviously scale is good, but as asset manager, we have a financial responsibility and duty towards the ecosystem as well. And we have the power to influence the ecosystem, not only at the annual general meeting of corporates, but because we are discussing with regulators, we are discussing with policymakers, we are discussing with clients to educate them, we are discussing with the corporate we invest in. So it's not only when it comes to the vote, obviously this is a must to have a voting policy, but as well to be proactive in all of the actors of the ecosystem we can engage and we are engaging with.
And Fanny, let me come back to you with a question that this is something I just read about going on in Europe. Again, excuse my US-ness on this, but you guys are making your regular ETFs, you're ESG-izing them, it seems like. So I guess, can you talk about the option of going with a true ESG ETF, or perhaps a clean energy ETF, or perhaps just holding your basic ETF and assuming it will be ESGized so I don't have to worry about anything?
No, that's a fairly good question. And it comes to choose the right index that suits you at first and what you want to achieve with your investment. Whatever you will do in the UCITS European ETF, and particularly at Amundi, is that we will make sure your money is heard at the annual general meeting and at the corporate management meeting. At the end of the day, the regulation is pushing in Europe, and as we see, we have an advanced regulation, a European regulation, and advanced local regulators as well, that pushes to disclose what is the ESG policy of each fund, and with the SFDR regulation on one side, and also some local labels by countries, which are also redirecting the capitals toward ESG product and incentivizing by educating institutions, retail investors to redirect their investments toward ESG. At the end of the day, there is a very good variety of ESG offering, even though we believe it can be developed, tackling various ESG needs and demands about broad ESG, clean energy, thematic ESG on one side. But at the end of the day, you need to choose the index that suits your investment objective. And this is accelerated by the European regulation as well to make it public and also to make sure that people are educated toward that ESG concern.
And just, real quick, if I'm an ESG investor, I'm interested in this, I like it. How much do I need to sort of be maybe a little honest with myself about my own consumer habits? And I'll turn this to Wolfgang, since you're studying this a lot, and Fabrizio, anybody can answer this one. Maybe I shop at Amazon, I use Exxon to fill up my car, and yet do I want to exclude those stocks given that I'm a customer of them? How should we think about reconciling that? I'll start with Wolfgang.
Well, that's an interesting question. I suppose you want to be as consistent as you can be. But again, it comes back to what do you mean by ESG? Are you interested in the best long-term returns? Or are you considering objectives regarding people and planet? When it comes to the latter, then you want to do as much as you can. If you like, I don't know, flying around the planet, that doesn't mean you also have to invest in airline companies. You have to start somewhere. We would say, though, that when it comes to, and that's about choosing indices, Franny has talked about that. When we criticize passive fund providers and say, why are you invested in X, Y, Z? They say, well, we have to. This is an index. This is the S&P 500. We would say that there's no reason, there's no God-given, this is the market, you have to buy it. If you want to do passive investment, then choose your index and choose it wisely so that it doesn't have ESG risk all over it, and it possibly aligns with your values.
Fabrizio?
Yeah, very interesting. Sorry, I don't want to look like an American here, but I want to answer this question with a famous quote from Mark Twain. Two of the two most important days in your life are the day you're born and the day you find out why. I think purpose and motivation are driving our actions. And I think as a society, this is a journey. We are in the process of building this purpose. And this should be, 100% sure, leaving to our kids a better planet and a better society. For this reason, I believe we should be investing in ideas or in initiatives that make this possible. And this maybe means changing our habits. I would agree. We are heading, I guess, the right direction. And why I say that? I see more electric cars on the road. I see more bike lines. But the road is still long. And then to your question more specifically, I would talk about self-indexes, for example, that could be hyper-tailored and attached to a specific ESG team or segment. And the manager designs and labels its own specialist index, but it's very, very tailored. So as Fanny was saying, they can choose and pick something that is more aligned with their value or their type of investing. What I wanted to say here is that increasing demand for ESG ETF to have a genuine impact is growing, right? And this is also leading, which is very, very interesting here, is a greater collaboration between the ETF issuers and the asset managers and the index providers. We have different examples here. And just to give you a stat, according to our research, 19% of the issuers we surveyed in Europe expect to develop a self-index proposition, while 57 of them see it as an opportunity. There is some caution here that we have to take because of the benchmark regulation are in place to mitigate conflict of interest. But as the quality of data improves and technology makes it easier to process and analyze non-financial information, I would dare to say that in the ETF issuers, managers, together with index providers, they will bring more tailored ESG indexes. And this is good for investors because it means that the menu is growing.
Fanny.
Yes, there is, and to complement what Fabrizio was saying, obviously an institutional investor has the power, the scale and the resource to make his own ESG policy adapted and designed. What we are trying to achieve is to make sure on the other way around, ESG is accessible to the man in the street, which will not have the power to make its own ESG policy. And so to make it, we work on two elements. The first one is to have a large ESG offering to make sure that we can democratize various types of ESG investing to the vast majority. The second element is exactly what you were mentioning, is to work beyond what's offered at the indexing and the traditional index provider level to make sure we co-construct ESG products with them to tackle what could be the concern of tomorrow. And yes, obviously, let's make it clear, as a passive investor, we have the financial duty to replicate the index our clients are asking us to replicate. So the question is, how do we transition the stock To come to Wolfgang's point of view, the stock we are having into vanilla non-ESG indices, and the transition will be done into two folds. The first one is to make sure that those money invested into traditional non-ESG mandate or funds are used to leverage the annual general meeting and to educate corporate on one side by voting against if necessary. And on the other way around, it's a question of education and sometimes voluntarily transforming, as we did, and to rebound on the S&P 500 transformation that we did last year to transition our S&P 500 to S&P 500 ESG ETF.
That's great. And Fanny, you just tapped into the last. I had a couple audience questions, and the only one that wasn't answered by you guys already was the future. And you kind of touched on it right there. And what's perfect is we're out of time. So we actually got to all the audience questions through this conversation. So great job, everybody. Thank you very much for all of your insight today. And now I want to pass it off to my colleague and friend, a fellow analyst, Athanasios Serafagis at Bloomberg Intelligence. He's going to talk about the outlook for European ESG ETF growth in 2021. Take it away, Athanasios.
Thank you, Eric, and hello, everyone, and welcome to this second part of the event. My name is Athanasios Serafagis. I am an ETF analyst with Bloomberg Intelligence, and I'm going to be going over the ESG landscape. Obviously, one of the reasons why we're even having this event is the extreme growth that we've seen in this space. So I'll kick it right off. I've got a bunch of charts we can go through, but let's just look at the actual size of the market. It's been growing exponentially. If we look at global ETF assets, we're at about 260 billion globally. As you can see, the growth has really sort of come in the last couple of years. And if we look at Europe in particular, that's really been the leader in the space. About 40% of the market is in Europe, but the U.S. Nonetheless is growing very quickly, and we're seeing a lot of growth in the Asia Pacific market as well. But Europe has really been sort of the leader here in this space. If we look at flows that had come in over the last couple of months, and especially in 2020, it was a record year, and for Europe in particular, ESG ETFs took in 43 billion. If we look at it in the context of all flows into the European market, that accounted for about 40% of all flows. So as you can see clearly, there's a big focus on ESG from investors continuing to allocate resources to these products. And a couple of things that I thought were really interesting in terms of the pattern of the flows was not only the magnitude and the size, but the stickiness, meaning if you look at last March or even in the recent events, some of the market volatility, no money had left ESG. So you can see that very much these investors are long-term investors. They're very devoted to the product, and they're likely to stay with it despite some of the market volatility. And with some recent regulation coming into play now, like SFDR in particular in Europe, I think this is going to continue to grow very quickly. I think some of the growth rates are going to sustain what we've seen last year. And so, of course, because of that, you're seeing a lot of the issuers focus on launching a lot of ESG product. Last year, about half of the product launches in Europe were ESG focused. And one area in particular that's seeing a lot of growth is fixed income. It's a little bit smaller than some of the equity ESG products space that we've seen, but there's continued development and work in fixed income. And I think that's where we're going to see a really big focus, especially this year. And I always hear this argument all the time, and people often think that if I'm buying into an ESG fund, it's more expensive or it's just a way for the issuers to make money. But that's actually not true. If you look at the average fee for an ESG ETF compared to a comparable core product, it's actually for ESG, it's significantly lower. And this is European data, so you can see there's almost a 10 basis point drop in average fees for someone allocating to an ESG product. And as we see more and more products come into market and this space grow and really gain some scale, I think we'll continue to see more aggressive fee cuts. We already saw some of that last year. But I think this is going to be a space that cost compression will continue to be a big player. And this is also, I think, one of the reasons why Europe is a little bit ahead of the US. If you look at these fees in the US market, the spread, the change isn't as significant in that market. So Europe, again, allocating to an ESG product is actually on average cheaper than a core product. In terms of some investments being made in the space, most ESG ETFs are tied to an MSCI index, but there's a lot of investment being done by the other index providers, mostly acquiring other ESG firms, data providers. And I think this is really going to do a couple things. One, add more competition to the space, which I think is always good. And I think it's also going to help standardize the industry, meaning help more streamline ratings and data. And I think this is really important because if we look at what some of the biggest challenges are and some of the biggest pushback on ESG, it's just inconsistency in the ratings, right? And I think this falls on the entire industry, whether it's the issuers, ETF analysts, index providers, to keep providing education and keep streamlining this process. And I think as that continues to get tighter, we're going to see even more growth in the space. And with that, just to let you know where you can find all of our research on the terminal, we are at BIETF for the US. And this is where you can find some of these charts, and all of our research is published there. So feel free to reach out or check us out on the terminal. And with that, it's time to pass it over to my colleague, Danny Berger, who's going to run our next panel discussion. Thank you.
Thank you, Athanasios, for that very interesting conversation and presentation. I'm delighted to introduce our next panel of speakers that's joining us for this very topical conversation. So joining us today, we have Remy Bryant, Head of ESG at MSCI. Also joining us, we have Emily Krebs, Global Director, Capital Markets Team at CDP. And last, we have Kieran Aziz, Senior Analyst, Responsible Investments at KLP. First off, thanks everyone so much for joining us. And I actually want to do something a little bit different today and start with an audience question that we've just gotten, because it's an important one, not just for ESG investments themselves, but just for investments in general and ETFs. And that's whether an active strategy or a passive strategy makes the most sense for investing in ESG. Remy, why don't we kick it off with you? If you could kind of give us a lay of the land when it comes to this debate.
Sure. And probably the first question as an investor you would want to ask yourself is, what is your objective in terms of what you want to achieve for your climate or ESG dimension? If you think about it, you can either go for, at one extreme, a very well diversified equity and bond option, where you would want a big reduction in carbon emission and alignment, with the Paris objective, but still a very broad portfolio. In that case, which you can describe, it's the sleep well at night option. You will go in one direction, but at the other end of the spectrum, you can focus on green, clean tech, highly volatile Chinese stocks in your portfolio. In that case, you need to watch very carefully the portfolio every day. But those are really very different objectives. So that's the first question: is what do you want in terms of your outcome, both in terms of general risk, but also emission reduction, alignment with the Paris framework, as well as how much green companies you want in your portfolio. Then you look at the choice of options, and you will find choices both on the indexed front as well as on the active side. And then it's really a matter, I think, of your own preferences. Either potential for outperformance for active, or essentially generally a lower cost solution for the index options.
Kieran, how do you view this? How do you view sort of the debate between whether an active or a passive strategy makes the most sense here?
I would say both have a role to play. It will really depend on what kind of investor you are. We, as Norway's largest pension fund, seen as an institutional investor, passive investments are mainly product. But when that's said, it's also because we are a long-term investor, and then you have much more a consistent strategy, and it's also quite low cost, which is important for us. But you can still play an active role by being passively invested. But on the other hand, the risk might be higher because you are quietly wider invested. Then you also have companies with quite low ESG performance. But on the other hand, you can then, by being quite widely invested, you can try to raise the companies which are on the bottom in order to set the right expectations.
And Emily, how do you frame this debate?
Sure. Well, I think there's a role for both active and passive funds with respect to being environmentally friendly or ESG friendly. And a lot of it just comes down to engagement. And so how the asset manager is managing, whether it be the active fund or the passive fund, with respect to their engagement strategy and their analysis strategy. And we've seen fantastic engagement from some of the world's largest passive asset managers as well to meet the needs of their clients.
Kieran, if I could actually pick up on a point that you mentioned. So you said, in deciding this and constructing it, you need to decide, whether you want to include certain stocks, whether it's, sort of a positive inclusion that you have all the green, environmentally friendly stocks, or versus sort of an exclusionary type portfolio where you just, get rid of the big carbon emitters, the sin sort of stocks. How do you make that decision? What makes sense for most investors as an approach to picking a fund to concentrate on that E part of the ESG?
There, I would say that there is a combination because, there is a quite demand for a positive selection. And at KLP, we have some Nordic eco-label funds where you do the positive selections, such as the companies in part of that funds, will not be having involvement in fossil fuels, weapon, and so on. So there are quite strict ESG screening rules for that. But on the other hand, since we are passively invested and, we are invested in almost 10,000 companies. So you also have that opportunity that where you just, if the companies are part of the index, they will also be a part of your investment portfolio. And the good thing with that is that, like I mentioned previously, you can try to raise the bottom of the companies, which are quite far away from having any credible climate plans or any strategy in that term. And we also divest. We were one of the pension companies to divest from coal. So you have the opportunity and try to combine that.
Emily, do you see the same way in terms of sort of that engagement piece being important and actually holding these companies?
The engagement piece is really critical. I think when looking for investments, the transition is particularly key. And so what I mean by that is it's not just is this company currently green or not, but what is this company doing to transition to a future environment that falls within planetary boundaries? So what are they doing to set targets for emissions reductions? And I think that really has, if you're looking from an investment perspective, that forward-looking component that says, here is a company that is transitioning, that is changing their business and their operations in a way that is going to set them up better for the future. And so that transition process, in some cases companies are leading, in other cases the investor engagement is really critical to driving a company and pushing them towards that transition. And then as an investor looking for those companies or those funds that are focusing on engagement and transition, I think is a really important step to avoid greenwashing.
So then, okay, you take that sort of engagement piece, Emily, then how does that mean that by definition, you can't be exclusionary? You can't be exclusionary when you build these indexes because you need to be able to capture that.
No, not necessarily. I mean, I think Kieran had a really good point. You know, coal is something that is we're seeing more and more from an exclusionary perspective. But I think just saying we're only going to invest in these types of companies, that type of exclusion, may miss some opportunities for companies that are saying we are in a traditionally high emitting industry and we are going to find new technologies, new business models, new ways of operating that will transition us into a more environmentally friendly business model from that perspective.
So Remy, obviously MSCI has a lot of various ESG indexes. I mean, is there any sort of that make more sense for a fund? Or I mean, I know that there are a lot out there, so I'm assuming you have both types, but is this exclusionary or inclusionary one? Do you think either of them comes out stronger in terms of an investment vehicle?
Yeah, I think we would, the way we would think about it and then code it, if you want, in the index rules would be, at the end of the day, we're looking at a massive reallocation of capital in terms of moving towards the green economy. So that movement will lead to both risks, which is the stranded asset risk, and the risk then, if you want to manage it, will lead to either a heavy reduction of your exposure or an exclusion. But then there is the positive side, the opportunities. There will be also massive opportunities on the green side. So when you design a strategy and incorporate it to an index, then you want to reduce the risk, including in sectors, by the way, that are not necessarily the high emitting sectors. So for example, in an industrial company that would sell mostly component to an engine that is an internal combustion engine has as much stranded asset risk as an oil and gas company, because their business activity will disappear if all the cars becomes electric car. So it has to be a relatively wide analysis across the market under a reduction, and then on the opportunity, then you start looking at the companies that have a high level of green activity, and you combine the two, and this is really pretty much what is a Paris-aligned index would capture in a rules-based approach, and that would be a little bit our preference, is to get all those dimensions incorporated into one solution.
So I do want to go back to this question of engagement, because I think it is a really important one when you're talking about, owning these types of funds, that sort of thing. Kieran, how important is this? Because a lot of the different ESG offerings out there, you think of big fund managers who own a lot of companies. It's difficult for them to do necessarily direct engagement if they're owning hundreds of companies. I mean, is this an issue for a lot of ESG offerings, that perhaps a lot of the managers can't be as hands-on and engaged with companies as perhaps they should be?
Engaging with the company, I would say that is one of the most important tools you have, especially as an institutional investor. You can still be passively invested, but you can play an active role, and it's about putting the expectations to the companies and follow up the progress they have. And let's say if they have credible climate plans, and then, as mentioned before, what is the strategy going forward. So engaging with the companies is a must, and we have KLP have used that quite actively. But when that said, I think one other component which is quite important about engaging with the company is about transparency, because we expect and demand transparency from the companies, and we should also be able to, when we exclude the companies or we do any kind of divestment, we should say what are the exclusion assessments we do, because in order to raise the bar for other investors and companies, and also for the companies that if they improve, they could be included back into the investments.
On that point, Emily, Kieran's talking about, a lot of the data that needs to be gathered from this when you're talking in the transparency. Is that a problem in the industry in trying to construct these portfolios? How is there enough data out there to work with companies, one, and to put them in a environmentally friendly portfolio?
So I feel like that's a real layup question for me, Danny. So thank you very much. So just to give a little context, CDP, which is the former Carbon Disclosure Project, we are a nonprofit. We take investor authority from KLP, from Kieran and 600 other investors, and we request of companies to disclose around climate change, water security, and deforestation. So we are a data collector, to be very clear, we're also a nonprofit, and so we collect data on behalf of investors and of the public markets, and we look to have that data, the company voice, then be used in analysis by Kieran, by the folks at MSCI, at Bloomberg, and others to really build on that. Now, this is voluntarily reported information, and we recognize that it's something that we've been building on for 20 years, particularly in the absence of mandatory reporting. So we'd like to think that, yes, there is a fair amount of data out there, but it's not going to be perfect, and not every company is going to be able to supply it. If you think about the development of accounting standards, that took 40 or 50 years, and we don't have 40 or 50 years to wait on the development for ESG data standards. So there is a lot of information out there aligned with the TCFD, the Task Force on Climate-Related Financial Disclosure. A company that discloses to CDP does answer all of the framework questions that the TCFD asks for. So there is information to get started, and there is information to be used for that engagement component that Kieran was talking about.
Remy, what's sort of the picture from MSCI's point of view? I mean, is there any sort of, if you could pinpoint, okay, this is what we're missing, this is a big sort of hole in terms of gathering data to build this. Is there anything like that that you would sort of point to?
Well, clearly, generally, the disclosure is still relatively low. It's increasing, thanks to the efforts of, CDP and also investors in general. But you still, I think, generally need more disclosure from company. If you look specifically at the emission, for example, scope 3 emission, which are really important, in sectors like the oil and gas, industry, the level of disclosure, the consistency of the disclosure is inadequate in a sense. But on the other hand, you can do a lot when you take the disclosed data and then you complement with models. And to take maybe an intuitive example, if you think about physical risk, for real estate, and to be a bit provocative, is the only data you need is the address. Again, it's more complicated than that, but you need the address. That's the data part, and then you have models that will look at the exposure to hurricane, flood risk, a lot of physical hazard, and so you can do a lot in terms of estimating the physical risk with this only data point, if you want. So I think we need to work in parallel, more disclosure and more consistent disclosure, from companies, and then more sophistication, if you want, in the model in order to still get a useful signal for investment purpose.
So I want to bring in. Oh yes, go ahead, Kieran.
I think it's fair to mention that within the European Union it's happening a lot, and European Union's taxonomy is a good example on that, where you see it's a really monumental shift for ESG when it comes to reporting obligation for the financial industry, and that's kind of show that where there are voluntary disclosure initiatives and where there is really by the law, then you will be able to see a difference in the years to come.
That actually is a really interesting point. I mean, Emily, when we do get that more of that framework being brought in, do you think that these investments will actually change a lot because, presumably you will get a lot more and consistent reporting from companies?
Well, I think a lot of it's going to depend on the information that's required from the various regulators, because the same way that we look at SEC reporting versus other regulatory environments, there are a lot of consistent metrics, but then there are some things that are different. And what's really critical is to look at the economies in which A, the companies operate, but B, the regulators regulate. So for example, the European Union taxonomy is very helpful, and it's been a leader globally. That being said, it may not work for natural resource intensive economies like Canada, the countries in South America, South Africa, Australia. And so we've seen the development of the Canadian taxonomy, for example. And so, you know, that really focuses on that transition taxonomy, which is important as well. So I think that we will see very location specific disclosures and regulations that are important. But I would be surprised if we converge on a global set of metrics that is applicable for all companies operating in all countries and all environments, because to Remy's point, the fiscal risks are very different across different areas.
Remy, with that in mind, does the ESG investment you have, depending on where it is in the world, the geography, the set of government guidelines, does the sort of fund you need to target differ then? Say if you're looking at a fund that's more Canadian-based, looking at Canadian equities versus French ones, does it need to vary widely given those discrepancies?
I think the investor preference will be slightly different, depending on the country. I personally think that both the transition risk and the physical risk are global. So you would construct your portfolio absent, preferences. I think the same way, regardless of where you are. But clearly, each country would have a different assessment of risk tolerance for certain concepts. So, for example, a divisive topic could be nuclear energy, where it is a low carbon solution. It's also a high risk solution. People may have different views on that, but from a purely, I would say, a overall an assessment of risk generally, I think we're not too far away. If you look at it from the US, Europe, or Asia. Right?
So I at this point, I want to bring in a viewer question, because we've been talking a lot about how this is, partially choosing an ESG investment. It's also about risk. But of course, another element to this is about return as well. So one of the viewer questions we have here, what is the expected return on investment from these ESG investments as compared to the rest of the market? Or perhaps the question is also, should there be a difference? Should it be very similar to the wider market? Kieran, I'd like you to take this one, of course, as someone who invests in these types of products.
Yeah, this is quite crucial for us, because our objective as a pension fund is to make sure that we are able to deliver on the obligations, and we can pay the entitled payments for the retiree, and that's why it expects that we are aligned with the return at the market level. But at the same time, you can also make sure that you can do that within a quite responsible manner. But but when we divest and when we do the exclusion, we look at how this will impact our product and the return, of course.
Yeah, Emily, what's sort of your take on whether this these are sort of tools to help you outperform versus just perform in the market, but do a more sustainable form of investing?
Well, I think that from our perspective, that looking at environmental metrics is very much a governance issue as well, because companies that are thinking about this in their operations, thinking about the transition, they're exercising good governance, and we certainly ask about that in our disclosure questionnaire. I know that Remy and his colleagues at MSCI have done some fantastic research back testing companies that have taken good transparency policies, governance policies, and how they've performed over time. I think anecdotally, as we talk to the investors that we work with, we have seen an outperformance in portfolios or portfolio tilts where the portfolio has been skewed towards companies that are focused on that transition, on that disclosure that I mentioned before.
And Remy, how kind of would you approach this at MSCI?
Yeah. So if you look empirically, in the last 3 years, there's been a dramatic acceleration of the green premium. So comparing green stocks versus brown stock, you definitely see, an increase in that premium. Going forward, which is the real question, I think the key element is do you believe that there will be a transition to a green economy? If you believe that, and if you believe that, all stakeholders, including investor, will shift money, then almost by definition, it'll create, stranded assets, and it will create opportunity. Hence, the premium will continue in a sense, until we get to an equilibrium. And my sense is that, given that the topic is not yet a consensus, in every country and with every type of investor, we still, are in that phase where people will have different opinion, and the repricing of green and brown asset will continue. But it has to be a sense of view of the future that every investor needs to make themselves.
Danny, I can also add that we see that there is a better performance for the eco-label funds we have, and we are starting one for emerging markets. So it will be interesting to see how that will be on, how that delivers.
What's your expectation for that, for how the EM one will perform?
As we said, it's the companies who have quite good ESG ratings. So given that they are working quite committed to ESG, so I'm quite certain that they will have the return we would like to see.
Well, we're just about out of time. I feel like that's a nice optimistic note to end it on. Thank you all so much for joining. It was really such a pleasure to get insights from everyone. I mean, everything from engagement to outperformance, lots of tools there to kind of help go out into the world and evaluate a lot of these funds. So we're going to leave it there. Thank you to all of our speakers for joining us today. Really grateful for your participation and perspective. To our audience, both within and beyond the Bloomberg community, thank you for joining us. You can follow the conversation at Bloomberg Live on LinkedIn, Twitter, or you can like us on Facebook as well. And to learn about other upcoming events, visit our website, bloomberglive.com. Thank you to our sponsor, Amundi, and everyone who joined today. Don't forget, you can watch this on demand. Thank you and stay well.